Good afternoon, everyone. Thank you for joining us this afternoon for an overview of Elective Pay and Alaska Native Entities webinar. We'll be joined this afternoon with the Office of Tribal and Native Affairs, the Office of Tax Policy, and the IRA Program Office here at the U.S. Department of Treasury. I'm going to pass it off to the Treasurer, Chief Linda Larabuff, to make some opening statements, and then we will continue with the program. Thank you.
So thank you, Emery. Wikiskiinawak. Greetings, everyone. We're really happy to have you join us today. These topics are really near and dear to all of our hearts as we try to kind of understand how all of these credits and elective pay can help our tribal nations. And I want to say thank you to all of our Treasury colleagues for being on the call today, because I know that you've been working diligently not only to get guidance out, but to help to make it understandable to our tribal nations. And so I thank you for your partnership, and I thank you for all of the work that you've done to date. So I will not belabor that point any further, but I will pass this over to Fatima Abbas, the first director of the Office of Tribal and Native Affairs.
Thank you, Chief Malerba, and thank you to everyone who's attending. So as many folks know, the Inflation Reduction Act includes $720 million in direct set-asides to tribes and Native entities for clean energy development, but the IRA also contains billions in clean energy tax credits that provide the potential for tribes and Native entities to unlock far greater financing than they've historically had access to. In today's webinar, we're going to cover a payment mechanism known as elective pay, which enables entities that typically do not have tax liabilities, such as tribes and nonprofits, to access some clean energy tax credits for the first time. Also included within elective pay are Alaska Native entities. And so in this presentation, we're going to go through the payment mechanism, the final rule, and some of the other aspects of accessing tax credits, such as transferability, and then also a specific bonus credit called the Low Income Bonus Credit Program that has an Indian lands category that covers both tribal and Angska lands. And our goal in this webinar is to increase awareness of these opportunities in Alaska for different types of entities, whether you're a tribe, a nonprofit, or an Alaska Native corporation. At the end, we'll take some Q&A. And on that, I'm going to turn it over to Anisha Stephen, who is on detail with the Office of Tax Policy, to begin. Anisha.
Hi, everyone. My name is Anisha Stephen. I am a senior advisor in the Office of Tax Policy. We can go to the next slide. The presentation today provides an overview of certain Inflation Reduction Act tax provisions for general information purposes only and is not itself guidance. The deck relies on simplifications to convey high-level points, and the content in this presentation is partially based on proposed regulations. Please refer to guidance issued by the IRS for detailed information on the rules associated with the various provisions discussed. Next slide. The Inflation Reduction Act is the most significant legislation to combat climate change in American history. It is also one of the largest investments in the American economy in a generation. And because the majority of these investments are delivered through tax incentives, the Treasury Department is honored to be at the forefront of implementing this landmark legislation. Today, as Fatima discussed, we'll be talking about a number of these provisions and specifically two credit monetization mechanisms. Next slide. So as an overview of the Inflation Reduction Act, under the IRA, there are 20 underlying tax credits that were created or modified. These include production tax credits for clean energy generation, manufacturing, and fuels, investment tax credits for renewable energy property, credits for clean vehicles and clean vehicle infrastructure, and then incentives for energy efficiency. Some of these credits also include or can be enhanced by bonuses. There are 4 of them. One of them is prevailing wage and apprenticeships. Another is energy communities. The third is domestic content. And then fourth is the low-income communities bonus credit, which I will talk in more detail about later in the presentation. The IRA also established 2 novel credit monetization mechanisms to expand the reach of clean energy tax credits. One is called elective pay or direct pay, and the other is transferability. Next slide. With elective pay, and again, we'll go into more detail about this, but tax-exempt and governmental entities that do not owe federal income taxes are, for the first time, able to receive a payment equal to the full value of tax credits for building qualifying clean energy projects or making qualifying investments. So unlike competitive grant or loan programs in which applicants may not receive an award, elective pay allows that entities get their payment if they meet requirements for both elective pay and the underlying tax credit. Next slide. With transferability, an eligible taxpayer can transfer all or a portion of certain clean energy credits to unrelated third parties in exchange for cash. Transferability will allow eligible taxpayers to take advantage of these clean energy tax credits even if they do not have sufficient tax liability to fully utilize the credits themselves. So there are some credits that are eligible for elective pay and others that are eligible for transferability, and I'll go through those next. Next slide. Of the IRA clean energy credits, 12 can be claimed via elective pay and 11 can be transferred. This slide and the one after that indicates which ones. First, there are production and investment tax credits for renewable energy and clean electricity, the first 4 rows. These are the main incentives for things like solar and wind installations. There are 4 separate tax credits because there are production tax credits and the investment tax credit that exists now. And then beginning in 2025, there are new versions of those tax credits, which are often called technology neutral, PTC and ITC, but they are broadly similar and in general offer the same amounts of credit, including the bonuses. One thing to note is that under IRA, the ITC covers energy storage as well as clean energy generation. And as you can see, both the ITC and the PTC in both their existing versions and the technology neutral versions are eligible for both elective pay and transferability. Some of the other credits are the zero emission nuclear production credit for existing nuclear power plants, the commercial clean vehicle credit, which can go towards investment in clean energy vehicle fleets, and then the alternative fuel refueling property credit for investments like EV charging stations. Next slide. So that was the high level of the tax credits that the overall IRA tax credits and what is eligible for elective pay and transferability. I'd like to focus in before we go into more details about those on the low income communities bonus credit program. The low income communities bonus credit program is under section 48 little e of the Internal Revenue Code, and it's an allocated credit bonus for a 10 or 20 percentage point boost for qualified solar or wind facilities less than 5 megawatts and that receive an allocation. Because it's an allocated bonus, it is competitive, and the Treasury regulations on the IRS website and revenue procedure details the rules and processes for owners of qualified solar or wind facilities to apply for an allocation of this capacity limitation. DOE is our administrative partner on this. They accept applications on behalf of the IRS through an online portal. The Department of Energy reviews the applications and then makes recommendations to the IRS about awards. Next slide. To be eligible for the program, an energy facility must be in one of 4 categories that qualify for either a 10 or 20% tax credit bonus. There's 1.8 gigawatts of annual capacity that is divided amongst the 4 programs, plus 325 megawatts that were carried over from the 2023 program year. So for this year, for 2024, there are 800 megawatts available for projects in Category 1, which are energy facilities in low-income communities. There are 200 megawatts for energy facilities located on Indian lands. There is 225 megawatts for energy facilities associated with federally subsidized low-income residential building projects. And there's 900 megawatts available for energy projects that have a direct economic benefit to a low-income household. In each of these categories, 50% is set aside for projects that meet additional selection criteria. Next slide. So, as I mentioned before, on the IRS website, we released a set of regulations and a revenue procedure that provides all of the information that an applicant would need in order to apply for the Low-Income Communities Bonus Credit Program. This includes information like the definition of a facility, what located in means, and specific documentation requirements. Next slide. So there are a couple of highlights that I would like to focus on for tribes and Alaska Native corporations. First, as I mentioned, half of each category is set aside for projects that meet additional selection criteria. That means that they are owned by tax-exempt entities and other entities, including tribes, tribal enterprises, and Alaska Native corporations. So in every category, 50% is available to them, in addition to the entire category of Category 2, which is facilities that are located on Indian land. Treasury included in that specific category that any project that occurs on Indian land must include a tribal approval that is included as an attestation. And again, there are 200 megawatts that are set aside there specifically for energy facilities on Indian land. I'd also like to highlight that in Category 3, projects that are part of low-income residential building projects, there is a requirement that the energy facility be associated with a list of specific housing programs. And in the statute, it does list housing programs that are administered by an Indian tribe or tribally designated housing entity under NAHASDA. Next slide. So again, just want to pinpoint that 50% of the total capacity is reserved for facilities that meet certain ownership criteria, tax-exempt entities, tribes, tribal enterprises, Alaska Native corporations. And we recently opened the application period for the 2024 program year. The Department of Energy is currently accepting applications. So please go look at those resources and submit an application if you have a project that's ready. As I mentioned, the Department of Energy is administering this credit for us. They have a homepage that has a number of program resources. They have an applicant checklist, a user guide, a number of FAQs, and some other resources to help applicants navigate the application portal. Next slide. Thank you. And I'll hand it over to the next speaker.
Good afternoon. My name is Amber McKenzie. I'm an attorney advisor in the Office of Tax Policy. I'm going to be covering elective pay, which, as Anisha already mentioned, is a novel tax credit monetization mechanism that allows so-called applicable entities, which includes Alaska Native corporations, to receive tax incentives as direct payments for the first time. We issued proposed regulations on June 14th of last year, and since then we've received written comments, held a tribal consultation, and conducted a public hearing. So the culmination of that work was the final regulations, which were issued on March 5th of this year. I'm going to cover 4 areas of the final regulations. First one is the definition of applicable entity here. So who is an applicable entity? Under the final rules, the following categories of entities are applicable entities. And as you can see here, they include Alaska Native corporations, as well as tax-exempt organizations, which the final regulations define as any organization described in sections 501 through 530 of the code that meets the requirements to be recognized as exempt from tax under those sections, which of course would include any entity that has received a determination letter from the IRS that is described in section 501c3. It also includes Indian tribal governments, their subdivisions, and their agencies and instrumentalities. As you can see at the bottom of the slide here, in general, only applicable entities, the bulleted ones on top, are eligible for elective pay. However, other taxpayers that are not applicable entities may elect to be treated as an applicable entity with respect to 3 tax credits for carbon dioxide sequestration, production of clean hydrogen, or advanced manufacturing. That election is only good for a period of 5 years and other restrictions apply. Next slide. So this slide is just a reminder that, consistent with the proposed rules, partnerships and S corporations are not applicable entities, so they are not eligible to make an elective pay election. And that's even if all the partners or shareholders are applicable entities. So the only exception is that a partnership or S corporation can elect to be treated as an applicable entity for those 3 credits I just mentioned. However, partnerships and S corporations are considered eligible taxpayers, and so they should be able to make a transfer election, which is something Sarah is going to talk about in just a minute. And in addition, an applicable entity may jointly own projects through an association that has properly elected out of Subchapter K, or a tenancy in common arrangement for federal income tax purposes. And if so, the applicable entity can make an elective payment election with respect to its share of the applicable credits determined with respect to its share of the underlying applicable credit property. And as Sarah will talk about in a minute as well, simultaneously with these final regulations, we issued proposed regulations intended to allow partnerships with applicable entity partners additional flexibility to elect out of Subchapter K, and thus make the applicable entity eligible to make an elective payment election with respect to its share of the applicable credits determined with respect to its share of the underlying applicable credit property. Next slide. So the proposed regulations stated that entities that do not have a filing requirement should determine their tax year. And based on comments, these final regulations clarify that an entity that does not have a filing requirement, for example, a tribal government that files a Form 990T solely to make an elective payment election, has flexibility on choosing their tax year. So such taxpayers, when filing their initial Form 990T, can adopt a tax year based on a calendar year or on a fiscal year, whatever makes the most sense for them and for their energy project. The only caveat is that they must maintain adequate books and records. And if the adopted tax year is different from their other books and records, they must be able to reconcile any difference between their regular books of account and their chosen tax year to support making an elective payment election on the basis of their chosen tax year. So there's an FAQ on this on the IRS website. It's FAQ number 23. And we've also included an example of how this works in the appendix, if this is of interest to you. Moving on, I wanted to highlight a special rule in the proposed regulations that enables entities to combine grants and forgivable loans with tax credits without reducing the amount of an investment-related tax credit. So for these 5 so-called investment-related tax credits, 30C, 45W, 48, 48C, and 48 big E, the amount of the credit is a percentage of the basis in property, or generally how much it costs to acquire the property. So the general rule is that a tax-free grant or forgivable loan would not be included in a property's basis, and thus would reduce the amount of these tax credits. However, we put a special rule in the elective pay regulations that states that if an investment-related credit property is funded by a tax-free grant or forgivable loan, entities can get the same value of eligible tax credit as if the investment were financed with taxable funds. The only caveat is that if a tax-free grant or forgivable loan is given to you for the specific purpose of obtaining the property, what the regulations call restricted tax-exempt amounts, the amount of the restricted tax-exempt amounts plus the applicable credit cannot exceed the cost of your investment. And so we have an illustration on the next slide. Here we have an example where a qualifying Section 48 project cost $1 million, and the project would qualify for a 30% credit or $300,000. And we have 3 hypothetical grants from the Department of Energy that are given for the specific purpose of obtaining and installing the Section 48 property. That means these grants are restricted tax-exempt amounts as defined in the regulations. I'm going to go a little out of order here. So Grant C is a grant in the amount of $1 million. And because the grant equals the cost of the project, the credit is reduced to 0. The entity gets the entire cost of the Section 48 project covered by tax-exempt federal funds, but does not qualify for a federal tax credit on top of that. Grant A is a grant in the amount of $850,000. Because the grant plus the credit exceeds the cost of the project, the credit is reduced to $150,000. So again, the entity gets the entire cost of the Section 48 project covered by tax-exempt federal funds, but the amount of the federal tax credit is reduced so that the grant plus the credit does not exceed the amount of the Section 48 project. Grant B is a grant in the amount of $500,000. Here, because the grant and the credit does not exceed the cost of the project, the credit is not reduced. However, in this example, the entity needs to come up with $150,000 of funds that are not restricted tax exempt amounts. So we often get the credit, what is not a restricted tax exempt amount. So a tax exempt amount that is not given for the specific purpose of purchasing, constructing, reconstructing, erecting, or otherwise acquiring an investment related credit property is not considered a restricted tax exempt amount. So based on comments in the final regulations, we clarified that the following are not restricted tax exempt amounts. First, a tax exempt amount from the organization's general funds. That's not restricted at all, so it's not a restricted tax exempt amount. Second, a tax exempt amount whose use is not restricted to the purpose of acquiring an investment related credit property, and it could be used to purchase other things. It's not restricted, so it's not a restricted tax exempt amount. And third, a tax exempt amount whose use is not restricted to the purpose of acquiring a particular investment credit related property and could be used for any of several different applicable credit properties. So it could be used to purchase an electric vehicle or a solar panel. So this one's a little bit harder because the money's use is restricted to section 6417 credit property. But we wanted to be clear that because it's not restricted and the entity has the choice, is not considered a restricted tax exempt amount. So this is the last part of my presentation. How do I claim and receive an elective payment? Our hope is that you or your clients will claim and receive an elective payment. And how do you do that? You may have already seen this, but the steps are to first identify and pursue the qualifying project or activity. You should make sure you satisfy all the eligibility requirements for the tax credit and any applicable bonus credits, if applicable, for a given tax year. For example, you generally need to place the project in service before you can make the elective payment election. And you also need to determine your tax year if you don't already know it. Second, you would complete pre-filing registration with the IRS. Matt is going to give some more information on this in a little bit, but in general, it's done on an electronic portal at irs.gov, and you will need to provide information about yourself, which applicable credits you intend to earn, and each eligible project or property that will contribute to applicable credit, among other information. And upon completing the process, the IRS will provide you with a registration number for each applicable credit property, and you will need to provide that registration number on your annual tax return as part of making the elective payment election. Third, you must file the required annual return as defined by the due date or extended due date and make a valid elective payment election. And annual tax return is defined as for any taxpayer normally required to file a tax return with the IRS on an annual basis, that return. So if you're an Alaska Native Corporation filing a Form 1120, you would make the election on your Form 1120. You must also properly complete and attach source credit forms in accordance with their instructions, which will require including supporting calculations and including the registration number or numbers you received during the pre-filing registration process. A valid election allows you to receive payment as a refund for the amount of the credit, or if you have tax liability, to offset that tax liability and receive a payment for any remaining amount. So the earliest date you can get your money is the due date of the return, but you have up until the extended due date of the return to make the election. Then you receive payment after the return is processed. In the next slide, we just have an example timeline giving the same information, but in a graphical view. So here we have a tribal government that's a calendar year taxpayer. The regulations specify that any taxpayer that's not normally required to file an annual tax return with the IRS should claim the credit by filing a Form 990T with the IRS. Form 990T is due the 15th day of the 5th month after the end of the tax year. So in this tribal government's case, it's due on May 15th. So what's happened here? The tribal government placed its clean energy project into service in 2023. In late 2023 or early 2024, before the tribal government's Form 990T is due, the tribal government completes the pre-filing registration process with the IRS and receives however many registration numbers they need for their project. Then the tribal government files its Form 990T between May 15th, 2024, the due date, and up to November 15th, the extended due date. The tribal government makes a valid elective payment election on its return because it provides all the required information, including the registration number or numbers. And then the IRS processes the return, and the IRS sends the tribal government a refund payment in the amount of the credit. And with that, I'll turn it over to Sarah.
Thanks, Amber. So my name is Sarah Harridan, and I am an attorney advisor also in the Office of Tax Policy. The first thing I'm going to talk about today is the proposed rules that we recently issued for applicable entity partners and partnerships that desire to elect out of partnership tax treatment so that the applicable entities can claim elective pay with respect to their proportionate ownership shares of the property or facility. So the first slide here just shows the principle that Amber discussed when she talked about the elective pay rules, which is that a partnership, no matter who its partners are, is not treated as an applicable entity. The caveat to that is except for the 3 credits that any taxpayer can claim elective pay with respect to for 5 years. But so this diagram just shows that a partnership that has an applicable entity, such as a tax-exempt entity or an Alaska Native corporation as its partner, the partnership itself cannot claim elected pay, and therefore the partners in that partnership cannot claim elected pay unless the partnership validly elects out of partnership tax treatment and the applicable entity partners separately make elected payment elections. So let's flip to the next slide, please. So what we've provided in both the proposed and the final regulations under 6417 is that unincorporated organizations that have applicable entity owners can elect out under Section 761A of the Internal Revenue Code. And what this slide shows is just what the rules are under Section 761A with respect to electing out a partnership tax treatment. This slide also shows what the existing regulations under 761A were prior to the proposed regulations that we issued in March. So can we go to the next slide, actually, please? So in response to the proposed regulations under 6417 that provided applicable entity co-owners could elect out of partnership tax treatment with respect to their renewable energy projects, we received comments from stakeholders raising that existing guidance under 761A on arrangements that can validly elect out of partnership tax treatment was limited, and it really required updates to be effective for clean energy arrangements. Specifically, stakeholders raised that certain facts and circumstances that are common to jointly owned and operated energy projects, for example, entering into long-term power purchase agreements, that those facts and circumstances appeared to violate some of the existing provisions of the rules under 761A. So in response to those comments, next slide, please. So in response to those comments, we issued proposed regulations under 761A in March at the same time that we issued the final regulations under 6417 that would add exceptions to the existing rules for electing out of subchapter K for co-ownership arrangements that are organized exclusively to produce electricity from applicable credit property, from a energy property or an energy facility, and for which one or more of the applicable entity co-owners plan to claim elective pay with respect to their proportionate share of the credits generated from the property or the facility. So what do the proposed rules do? They permit renewable energy investments to be made through a non-corporate entity. So for example, a limited liability company, rather than requiring direct co-ownership of the property or the facility by the owners. If you, a couple slides back, the slide that showed what the existing rules under 761A were, those rules required direct ownership of the property. So co-owners would not have been permitted to own the property through a non-corporate entity. The proposed regulations that we issued in March allow co-ownership to be through a non-corporate entity, such as a limited liability company, which our hope is that allowing that will open up additional possible financing structures for applicable entities seeking to use elective pay. The other thing that the proposed guidance does is it modifies certain of the joint marketing restrictions that are in the current 761A regulations to provide that the members of the organization can delegate their authority to sell for a period of more than 1 year their shares of the electricity produced to the same agent. But the delegation of the authority cannot be for more than 1 year. So what does that mean? That means that the co-owners to the property or the facility can all delegate to the same person, if they would like, And that person can enter into a long-term power purchase agreement on behalf of all of the co-owners, so long as the delegation authority to the agent is renewed on an annual basis. But the agent itself could enter into, for example, a 15-year power purchase agreement on behalf of the co-owners. Next slide. Oh, next slide, please. I think we already got there. So what are the requirements to take advantage of these new rules under 761? First, the organization must be owned in part or in full by one or more applicable entities. And those are the entities that Amber went through a few slides ago that are under the 6417 final regulations, but that include Alaska Native corporations. The organization's members must enter into a joint operating agreement with respect to the facility or the property that they own together, in which the members reserve the right separately to take in kind or dispose of their pro rata shares of the electricity produced, and including any associated renewable energy credits or similar credits, RECs, is what they're commonly referred to. That requirement is directly from the statute, the 761 statute, and so it continues to be a requirement under these new regulations. Third, the organization must also, pursuant to a joint operating agreement, be organized exclusively to jointly produce electricity from its applicable credit property, from the property or the facility, and for which one or more of the applicable credits listed in these code sections is determined. That means that the only arrangements that are eligible for this treatment are those that produce electricity. So those are the 48 credits, the 45 credits. There, you can see these are the credits listed in these code sections here. There are 5 credits. This requirement can be satisfied prior to the applicable credit property being placed in service, meaning that the organization will, at some later date, jointly produce electricity. And lastly, one or more of the applicable entities must make an elective payment election for the applicable credits determined with respect to its share of the property or the facility. Next slide, please. So here we have an example. I'll probably go through this example. I think we have some time really quick. So T, an Indian tribal government, who's also treated as an applicable entity under section 6417. T owns an applicable credit property with Y through a limited liability company under T's tribal law that has not made an election to be treated as a corporation for federal income tax purposes. They enter into a joint operating agreement in which they both reserve the right to separately take in kind or dispose of their pro rata shares of the electricity produced and any RECs produced. On January 1st, they enter into a delegation agreement with Q which they delegate their authority to sell the electricity generated by their shares of the property. The term of the delegation agreement is 1 year, which is important. On June 1st of that year, Q enters into a power purchase agreement with the utility on the behalf of T and Y that commits them to sell their electricity produced from their shares of the property for a term of 15 years to the utility. And at the end of the day, at the end of the year, on December 31st, the delegation agreements terminate. I'm not going to run through the analysis, but what this example shows is that this arrangement is acceptable under the proposed regulations, meaning that T and Y can own their applicable credit property through a entity, through the tribal limited liability company, as well as that their delegation to Q was valid under the regulations. Next slide, please. So that is everything. That's the conclusion of the portion of the program on the new 761A proposed regulations. I'm also going to talk for just a minute about the final regulations that were issued under section 6418 at the end of April this year. There's a couple highlights up here on the slides from the regulations. Just to back up for a minute, as Anisha stated earlier in the presentation, transferability, so what is under section 6418 is the complement to elective pay. And generally speaking, transferability is available for those taxpayers that are not eligible for elective pay. We can flip to the next slide really quick. Transferability is available for what is defined as an eligible taxpayer, which is really any taxpayer, any entity, person that pays either employment, income, excise tax, any of those types of entities would be treated as a eligible taxpayer, assuming that they are not an applicable entity. Next slide, please. Transferability mechanics, similar to elective pay mechanics, meaning that the transferor, the person who desires to transfer the credits, must register the property or facility. The transferor and transferee, the transferee being the taxpayer to which the credits are transferred, they must enter into a transfer election statement and file the statement with their annual returns for the year in which the credit is transferred. There are no further transfers allowed by the transferee, meaning if I buy credits from a transferor, I cannot then resell the credits to another transferee. There can only be one transferee. And transferors can transfer all or a portion of an eligible credit. So for example, if an energy property produces $100 of credit, a transferor can sell $50, $30, $20. It can also sell to an unlimited amount of transferees. Provided that the credits must include, each credit that is transferred must include a proportionate share of any applicable bonus amount, meaning that the bonus amounts, such as the 48e bonus amount that Anisha described earlier, they cannot be transferred separately. Next slide, please. There are special rules that apply to partnerships and S corporations under the transferability rules. I'm not going to go through all of this, but we've included these slides for your reference. And then next slide. And lastly, there's a number of other things about transferability, but just as highlights, there are two separate liabilities that are transferred along with the credits to the transferee, one being excessive credit transfer, which is directly from the statute, and the second being recapture, which applies to certain types of bonus amounts as well as certain types of credits, including investment tax credits. And this slide gives a little more information on that. So with that, I think that's the end. Next slide. I think that's the end. With that, I'm going to pass it over to Matt.
Thanks, Sarah. Thanks everyone for joining today. So I'm going to talk a little bit about energy credits online and how you claim these credits. My name is Matt Doyle, and I'm a senior advisor in the Inflation Reduction Act program office. So both elective pay and transferability, as Amber and Sarah were mentioning before, require something called a pre-filing registration process. That is a mandatory process for both, whether you're using elective pay or whether you're using transferability and planning to make an elective pay or a transferability election. The purpose of this pre-registration process is really twofold. First, it's really important for the IRS to be able to get information about these projects and for folks to go through the pre-registration process before filing a tax return so that they can help prevent fraud and improper payments from going out the door. Because they're doing some of this work ahead of time, when that pre-registration process happens, it's also going to speed up their processing of tax returns once they are filed. So, the regulations talk about how pre-filing registration process, how it works, whether, that election is for members of a consolidated group, the timing of pre-filing registration, other requirements, the need for each applicable credit property to have its own registration number. So to give an example there, let's say you have two different projects, maybe one's for a commercial clean vehicle that you might be claiming elective pay for, one's for perhaps a solar project. You would get two different registration numbers through the elective pay process for that. And then there's some other information that the IRS is going to ask for throughout the course of the process. They're going to need to know about the individual who is representing the organization in the pre-filing registration process, what organization they represent, and then about information about the project that you're pursuing as well. So there are a couple of things that I do think are really important to highlight is there are a number of different resources and user guides on irs.gov/electivepay, including a pre-filing registration tool user guide. It gives detailed information about how to go through the pre-filing registration process. There are also additional user guides related to permission management. So maybe you have multiple people in your organization who you want to have access to the pre-filing registration process that should be able to submit information about projects. The first individual that registers for your organization is going to be able to assign basically the permissions of additional users should you need them. So let's move on to the next slide. So here you can see a couple of different screens of what it looks like. It's entirely online. And so when you come to IRS Energy Credits Online, which is the name for the site, you'll see that there's this Clean Energy button that's circled on the left to get started. And from there, you'll go into this IRA and CHIPS credit registration, and that's how you get started with pre-filing registration. We'll go to the next slide. So as I mentioned before, there are a lot of different resources. I don't want to spend too much time kind of walking through all of them, but I really do encourage you to check out irs.gov/electivepay and the other resources on here. And